Welcome to today's deep dive. We are jumping straight into the mind of legendary investor Howard Marks.
Yes, an incredible thinker.
Truly, we're utilizing this incredibly detailed body of work centered on his philosophy from the most important thing, uncommon sense for the thoughtful investor.
And our mission on this deep dive is to extract a genuine shortcut to being a truly well-informed thinker. Because, we aren't just here to give generic financial advice.
No, definitely not.
Right? We want to uncover the actual mechanics behind why highly intelligent, heavily resourced people frequently make these catastrophic decisions. And more importantly, how you can adopt this elusive, uncommon sense to consistently outsmart the crowd.
So if we want to understand how to outsmart the crowd, we first have to look at the ultimate goal in the investing world, which is beating the market. But why is doing that so incredibly difficult?
It's notoriously hard.
It really is. And it seems like it comes down to this cognitive trap that catches about 99% of people, the myth that there is some simple, universally known formula for superior success.
Yeah, and the mechanics of average performance actually highlight why superior performance is so insanely difficult. I mean, if you, as an investor, just want average performance, it is incredibly easy.
Right, you just buy the whole thing.
Exactly. You don't need a formula at all. You can just buy a broad index fund that owns a tiny slice of literally everything.
Yeah.
By doing that, you will perfectly match whatever the overall market does. Zero effort required.
Just set it and forget it.
Yep. But because millions of highly motivated, highly educated people are all competing fiercely for those same exact dollars of investment gain, achieving superior performance, like actually doing better than average, well, that requires an entirely different edge in perception.
Right.
You cannot simply do the same things as everyone else and expect unconventional results.
Precisely.
Charlie Munger actually has this incredibly blunt quote about this that I think really sets the tone here. He says, "It's not supposed to be easy. Anyone who finds it easy is stupid."
Wow. Yeah, that's very Munger.
So blunt. But so if the easy consensus way just gets you average results, how do you actually find that edge? The concept that jumps out to me here is the difference between what Marx calls first level and second level thinking.
Yeah, that distinction is basically the entire foundation of uncommon sense.
Yeah.
For first level thinking is simplistic, it's superficial, it really just deals with the obvious.
Give me an example of that.
So a first level thinker looks at a situation and says, this is a good company, so let's buy the stock. Or, the economy is slowing down, let's sell.
Right, which, that sounds totally logical on the surface.
It does sound logical. But the problem is that every other first-level thinker is looking at the exact same data and coming to the exact same conclusion. And by definition, that cannot be the route to superior results.
Because they are the market. Exactly.
Collectively, all those investors literally are the market. Their collective opinion is already baked into the price of the asset. Second-level thinking, however, is deep, it's complex, and it's kind of convoluted.
How so?
Well, the second-level thinker looks at that exact same situation and says, yes, it is a good company, but everyone thinks it's a great company. And because everyone is so optimistic, the stock is completely overpriced. So let's sell.
Oh, wow. So it's about playing the board one move ahead of everyone else. I was actually trying to think of a way to picture this in everyday life.
Okay, let's hear it.
So first level thinking is like checking the weather on a Saturday morning, seeing it's a beautiful sunny day, and just excitedly deciding to pack up the car and go to the beach.
Makes sense.
Right. But second level thinking is realizing that absolutely everyone in the entire city just saw that exact same weather report. So the beach is going to be this miserably crowded nightmare with absolutely no parking. And so you decide to hike up in the mountains instead.
What's fascinating here is that the mountain hike is a really good start to understand the concept. But in finance, the stakes of the crowd's behavior are actually much, much higher.
Yeah.
Yeah. Imagine if you and a million other people hiking the mountain actually cause the mountain to physically collapse under the weight.
Oh, geez.
That is literally what happens in markets. When the herd all rushes to the same side of the boat capsizes. To win, your thinking has to anticipate not just the weather, but the crushing weight of the crowd's reaction to that weather.
Wait, I actually have to challenge this premise just a bit, because if everyone out there is trying to be a second-level thinker and everyone is trying to outsmart everyone else, shouldn't the market eventually just balance itself out?
Ah, the classic counter-argument.
The Chicago School of Economics pushed the efficient market hypothesis for decades, right? Doesn't that theory argue that because there are thousands of objective, hardworking analysts constantly crunching data, there are basically no uncrowded mountains left. That everything is perfectly and fairly priced all the time.
That was indeed the prevailing academic theory for a really long time. The efficient market hypothesis basically claims that the market immediately incorporates all public data into the price of an asset.
Right.
Meaning there are no bargains to be found and no overpriced danger zones to avoid. But the primary flaw in that hypothesis is this massive assumption of human objectivity. And to highlight why this fails in reality, just consider Yahoo in the early 2000s.
Oh, right, the dot-com bubble.
Exactly. In January of 2000, Yahoo stock sold at $237 a share.
That is wild.
And by April of 2001, so just over a year later, that exact same stock was selling at $11.
$11 from 237.
Yes. So if you believe the market is perfectly efficient and always rational, you have to argue that the market was absolutely right when it priced Yahoo at 237 and also somehow absolutely right when it priced it at 11.
Which is mathematical nonsense.
Total nonsense. The market had to be massively, glaringly wrong on at least one of those occasions.
Which really proves that prices are not driven by clean math. They are driven by the pendulum of psychology. I mean, markets don't just gently correct themselves back to a rational baseline. They swing violently.
Very violent.
They swing between extreme euphoria and extreme depression, between blinding greed and absolute fear.
And we have so much historical proof of this pendulum swinging wildly. Take the Nifty 50 era from the late 1960s. Investors identified America's absolute best, fastest-growing companies, names like IBM, Xerox, Kodak.
The untouchables back then.
Exactly. They decided these companies were so invincible that the price simply didn't matter. And to understand how crazy this got, we really have to look at price-to-earnings ratios, or PE ratios.
Right, let's break that down for the listener. What does a PE ratio of 80 actually mean in real everyday terms?
Sure. Think of it like buying a small business. Let's say a local coffee shop makes $1 of pure profit every year. How much would you actually pay to buy the whole shop?
I mean, normally maybe I'd pay $10 or $15, expecting it to take 10 or 15 years to earn my money back.
Exactly. That's a PE of 15. But in the Nifty 50 era, investors were willingly paying $80 or $90 today for companies that only generated one single dollar of profit a year.
That is insane.
It was mathematical insanity masked as optimism.
Just because it was IBM.
Yes, just because of the name. And within a few years, reality set in. The pendulum swung back hard. Those ratios crashed from 80 down to 8 or 9.
Oh, wow.
That meant investors who had bought the supposedly safest, best companies in America lost up to 90% of their money. Not because the companies failed, they were still making money, but because of the psychology driving the price was completely divorced from reality.
Okay, here's where it gets really interesting, and honestly where I struggle to understand the professional financial world. I totally buy this psychological pendulum argument for an everyday retail trader sitting at home, getting caught up in the hype on Reddit or whatever.
You're the amateur investor.
Yeah, but Wall Street, we are talking about literally millions of analysts. They are highly educated. They are backed by billions of dollars. They have supercomputers running algorithms around the clock. How on earth can they all be so completely uniformly wrong right at the absolute top of a bubble?
This is the crux of the issue. You have to look at the institutional incentives. Professional money managers are human beings operating in a corporate structure, right? They aren't clinical computing machines.
Right.
Imagine you were a portfolio manager during a massive bubble, like the tech boom in 1999. Every single day, you watch your competitors making easy fortunes, buying terribly overpriced internet stocks.
And your clients are probably calling you constantly asking why you aren't making them that same easy money.
Exactly. The pressure to conform to the herd becomes a matter of actual professional survival. If you buy into the bubble with everyone else and the bubble pops, well, you probably won't get fired because everyone else lost money too. You just shrug and blame the market.
Right, safety in numbers.
But if you try to be a second-level thinker, if you refuse to buy those overpriced stocks and the bubble keeps inflating for 2 more years, you look like an absolute idiot. Your clients fire you. You lose your career.
Wow.
Therefore, the institutional incentive is actually to abandon logic and buy in at the absolute highest, worst possible times just to keep your job. Career risk entirely overrides investment risk.
That is wow. So it's not that they don't see the math. It's that the system basically forces them to ignore it. Which leads us directly to what might be the single most misunderstood concept we're going to talk about today: risk.
Yes, risk is huge here.
Because the herd, and obviously even the professionals, misunderstand what risk actually is, and they end up walking completely blindfolded right into disaster.
Let's look at how academics and financial theorists actually define risk. Because they needed a way to measure risk for their computer models, they defined risk simply as volatility.
Meaning how much it moves.
Right. It is mathematically convenient to look at how much a stock price bounces up and down on a chart and just call that its risk. But this definition is fundamentally flawed in the real world.
Because nobody actually cares about a chart wiggling.
Precisely. You, the listener, you don't decline to invest your savings because you're afraid the account balance might bounce around a little bit next quarter. You decline because you are terrified of losing your life savings permanently. Therefore, true risk isn't volatility at all. True risk is the probability of permanent loss.
There's this brilliant quote from Elroy Dimson that captures why this is so hard to wrap our heads around. He says, "Risk means more things can happen than will happen."
I love that quote.
It's so good, and it directly ties into the work of Nassim Nicholas Taleb and his concept of alternative histories. We have this terrible habit of looking at a past decision, seeing that it worked out well, and concluding it was a smart decision. But a bad decision that just happened to get lucky is still fundamentally a terribly risky decision.
Taleb uses a very dark but effective analogy to explain this: Russian roulette. Imagine reality is a revolver, but instead of 6 chambers, it has thousands of chambers and only one bullet.
Okay, grim but tracking.
Right. You can pull the trigger, not get shot, and walk away claiming it is a brilliantly safe, low-risk game. You might even be celebrated by the media as a genius for taking the bet and winning. But in reality, you aren't a skilled player. You're just a lucky idiot who survived an incredibly dangerous gamble.
I want to frame this for you, the listener, in a way we've all probably experienced at some point. Think about a time you were driving home late at night, and you decided to speed, maybe driving 90 or 100 miles per hour down the highway.
We've all been young and dumb.
Exactly. And you pulled into your driveway safely. Now, just because you survived, which is the final outcome, does that mean the decision to drive recklessly wasn't massively risky? Of course not. The hidden alternative history lurking right next to your safe arrival was a fatal car crash.
Right.
Just because the crash didn't happen this time doesn't mean the risk wasn't sitting right there in the passenger seat the entire drive.
And this raises an important question. How exactly do we measure a disaster that never actually happened?
That's the million-dollar question.
It is. Because the unsettling truth about risk is that it is entirely invisible in the good times. Think about building a house. A poor builder who cuts corners, uses cheap materials, and incorporates deep structural flaws into the foundation looks exactly as good as a master builder.
Right up until the earthquake?
Right up until the moment an earthquake actually hits. During the sunny days, you can't tell the difference between the two houses. Loss is simply what happens when hidden risk finally collides with a negative event.
So if the future is just this wide distribution of completely unknown probabilities and these invisible structural risks are always lurking out there in the dark, how do we actually survive? Like, if we can't perfectly predict the earthquake, what is the strategy?
The answer lies in a complete paradigm shift. You have to move your focus away from offense and entirely toward defense.
Defense, okay.
Yeah. There is a fascinating analysis of tennis by Dr. Simon Ramo that perfectly illustrates this. Ramo pointed out that professional tennis is a winner's game. If you watch the pros, the match is won by the player who actively hits the most brilliant, unreturnable, powerful shot.
Right, they are proactively winning the points. But I know from personal experience, as a truly terrible amateur tennis player, that is not how my games work at all.
Exactly. Amateur tennis is a loser's game. In an amateur match, you don't win by hitting spectacular winners. You win simply by keeping the ball in play, safely over the net, long enough until your opponent inevitably makes a clumsy, unforced error and beats themselves.
I feel seen and slightly attacked.
Well, the argument here is that investing, and honestly most complex decision-making for the vast majority of us, is absolutely a loser's game. You don't win the long game by hitting spectacular financial home runs. You win by consistently avoiding fatal mistakes.
To put that into practice, the financial world can basically be divided into two camps.
Yeah.
The I know school and the I don't know school.
Ah, yeah.
The I know school is full of those arrogant forecasters on TV who boldly predict exactly what the global economy is going to do next year and then bet their clients' entire portfolios on that single fragile prediction. But the I don't know school is completely agnostic.
The I don't know school admits that the future is fundamentally unknowable. So instead of trying to predict the unpredictable, they prepare defensively for multiple different outcomes. They rely on what Warren Buffett calls patient opportunism.
And Buffett actually compares investing to baseball, but with one massive unfair advantage, right?
Yes. In investing, there are no cold strikes.
I love this concept. If you are standing at home plate in a real baseball game, you have to swing eventually, or the umpire strikes you out. But in the market, you can stand at the plate for years.
Literally years.
You can watch thousands of pitches, thousands of different investment opportunities fly right past you. You are totally unpenalized for doing nothing. You just wait patiently for the absolute perfect pitch right in your sweet spot before you finally decide to swing.
And when you finally do decide to swing, a defensive strategy demands one critical element: a margin for error, which is often called a margin of safety.
What does that mean in practice?
This means demanding a purchase price so incredibly low or a deal so heavily skewed in your favor that even if your fundamental thesis turns out to be entirely wrong or the entire global economy tanks unexpectedly, you still survive. The low price itself acts as the ultimate shock absorber against an unpredictable future.
Okay, so we've talked about tennis and baseball, but how do we balance offense and defense at the same time? Let's bring in one more sports analogy to tie the actual mechanics together.
I'm ready.
Unlike American football, where you have a highly specialized offensive squad that completely leaves the field to be replaced by a specialized defensive squad, managing a portfolio is like playing soccer.
Oh, that's a great way to put it.
Right. The exact same 11 players have to play both offense and defense simultaneously. You cannot just call a timeout and completely swap out your entire portfolio when the market environment suddenly turns hostile. So what does this all mean?
This dual capability, playing offense and defense simultaneously, is basically the holy grail of investing. In technical terms, theorists differentiate between alpha and beta. Beta is simply the natural upward drift of the market.
Like the tide rising.
Exactly. It's like standing on an escalator. Anyone can ride the beta upward when the economy is booming. It takes zero skill.
You just buy the index fund we talked about earlier.
Precisely. But true alpha is genuine personal skill. It is the ability to climb the stairs faster than the escalator, but more importantly, it is highly asymmetrical.
Asymmetric.
Yes. True alpha means capturing the upside during the euphoric bull markets, while significantly limiting your damage when the psychological pendulum inevitably swings the other way and crashes.
I see.
Superior investing isn't about hitting home runs during a bubble when everyone else is also getting rich. True alpha is about successfully avoiding the devastating permanent losses that wipe everyone else out during the crash.
And here is why you, our listener, need to care about this, even if you never plan on picking a single stock in your life. Because these concepts scale directly to your daily life. Think about your career trajectory, your business decisions, or just your major life choices.
They apply everywhere.
They really do. Are you applying second-level thinking, or are you just following the herd because it feels safe? Are you demanding a margin for error in your life plans, or are you assuming everything will perfectly follow the supercomputer's math? Understanding these forces protects you from being blindly swept up in the emotional pendulum of the crowd.
Absolutely. By recognizing that real risk is often invisible during the good times and that luck heavily influences short-term outcomes, you can stop confusing a lucky break with personal genius.
Ouch. But true.
It is. You learn to insulate yourself against those dangerous alternative histories that could easily have derailed your plans. You become a patient opportunist in your own life, ignoring the pressure to swing at every pitch and simply waiting for the ones you know you can hit.
I want to leave you with one final, maybe slightly uncomfortable thought to mull over today. Take a moment and look back at one of the biggest, most celebrated successes in your own life or career. Really examine the mechanics of how it happened.
That's a deep question.
It is. Was that outcome truly the result of genuine, replicable, second-level skill? Or did you just happen to roll double sixes in a game of chance where the bullet just didn't fire? How many invisible, disastrous alternative histories were lurking right beside your success, completely unseen by you and everyone else?